To understand how general-purpose technologies actually integrate into society, we have to look at an apparent contradiction. While market valuations for a new sector implode, the physical infrastructure enabling that technology is often being pushed forward at peak speed. The collapse of tech stocks rarely means the underlying technology has failed. Historically, the most brutal market corrections happen precisely when a new technology begins scaling across the real economy. Economist Carlota Perez observed that technological revolutions do not assimilate smoothly. Instead, they follow a recurring, cyclical struggle between finance and industry. By analyzing this macroeconomic surge cycle, we can trace exactly how technical breakthroughs transition from wild speculation into baseline utilities. The massive capital misallocation we see during tech bubbles is actually a required mechanism. The market must overinvest in a frenzy to rapidly finance the incredibly expensive foundational infrastructure of the future. We begin with financial capital. This is wealth held as liquid money. The agents of financial capital are footloose. They seek yield wherever it exists, regardless of the actual product being built. Their primary function is to reallocate wealth. If an asset shows high returns, they flood in. If risk outweighs potential profit, they immediately flee. Production capital acts as the opposing force. These are the engineers and builders who generate wealth by creating tangible systems and services, like Henry Ford, whose focus was entirely on operational capability and scaling output. Unlike the liquid nature of finance, production capital is tied down. It is locked into fixed physical assets, geographically bound supply chains, and proprietary knowledge. This makes it inherently rooted and highly exposed to risk. The friction between the footloose, risk-averse nature of financial capital and the fixed, long-term commitment of production capital serves as the engine that drives structural economic change. This diagram maps the life cycle of a technological revolution, measuring diffusion over time against captured value, dividing the timeline into installation and deployment periods. Every cycle begins on the far left with eruption, a technological big bang, where financial and production capital move closely together. A classic big bang is the 1971 microprocessor invention. This hardware opened entirely new profit opportunities that the old economy simply could not offer. This eruption happens because the existing industrial system, the oil-heavy mass production model of the 1970s, reaches market saturation, facing stagnation and diminishing returns. With older industries failing to deliver high yields, idle money floods into the new sector. Financial capital eagerly funds this new class of emerging entrepreneurs. This initial phase effectively forces conservative, dormant capital out of stagnant markets and into highly experimental, nascent technologies that would otherwise starve for funding. Early success trains financial capital to expect massive, exponential returns, setting a dangerous new baseline for what a normal yield should look like. Returning to the chart for the frenzy phase, the financial curve violently separates from the steady growth of the production curve. This gap is the decoupling, where paper wealth, driven by speculation, completely detaches from the actual real-world value of the underlying businesses. Yet this irrational exuberance performs a critical function, forcing a massive surge of capital into base infrastructure that rational actors would deem too risky. A bubble is the mechanism used to rapidly subsidize expensive fixed assets. Without speculative mania, global fiber optic networks could not be built fast enough. The illusion of infinite capital gains cannot last. The tension between soaring paper valuations and actual dividends eventually snaps. This diagram shows the inevitable correction, known as the turning point. The inflated financial curve crashes downward, forcing paper values back into strict alignment with actual production value. These implosions happen with striking regularity. Massive panics predictably wipe out paper wealth and speculators when the frenzy reaches its absolute peak. The fallout initiates institutional recomposition. Regulators step in to establish new rules, taming financial capital and restructuring the economy around the new technology's realities. The crash operates as a mandatory cleansing mechanism. It strips power from paper speculators and hands control back to the engineers building real products. Following the reset, the cycle enters the deployment period. Its first phase is synergy, where financial and production capital recouple into a functional relationship. On the right side of our model, production capital takes the dominant trajectory, driving widespread economic growth. Finally, the cycle reaches maturity. The once revolutionary technology exhausts its potential, and both curves flatten out as they face market saturation. Established corporate oligopolies generate consistent profits, but find fewer opportunities for high-yield investment. The capital once again becomes idle money, desperately searching for higher returns. The stagnation of maturity directly funds the eruption of the next great technological surge. This chart shows 5 technological surges, where financial collapses predictably follow big bangs. Take the 1847 railway panic. Investors were ruined, but the physical tracks revolutionized trade. The pattern repeats. Mass production triggered the 1929 stock crash, and telecommunications brought the 2000 NASDAQ collapse. Despite the financial devastation of those specific crashes, the subsequent decades saw massive sustained growth in actual rail traffic, automobile adoption, and internet usage. The financial devastation of a tech bubble is completely distinct from the long-term utility of the technology itself. The collapse of the asset class does not mean the collapse of the infrastructure. Based on this macro framework, we must ask, are we currently in an artificial intelligence and Industry 4.0 bubble? Venture capitalists and economic historians point to the exact same cyclical markers to conclude that we are, and logically, we have to be. The era of intense GPU accumulation, rapid data center construction, and soaring AI valuations maps perfectly to Perez's frenzy phase. This current speculative frenzy is actively subsidizing the expensive hardware rails for a new industrial model. It is funding the shift to a pull economy, where the Internet of Things, 3D printing, and smart factories are driven by real-time data rather than forecasted supply. The impending tech crash is strictly a hazard for asset classes and paper valuations. The billions of dollars spent today will leave behind permanent compute infrastructure, which represents a structural expansion of our technical capacity. To enter the most productive phase of this cycle, we must allow the financial correction to occur, stripping power from the speculators trading paper and handing it back to the engineers building the factories and networks.